FAMPOSI 25, SCHD, the once celebrated dividend ETF that symbolized stability, faced one of its toughest years ever. The share price, which had long hovered around the high 70s and even touched $80 in late 2023, fell sharply through 2024 and early 2025, now sitting around $64 to $66 per share. For an ETF that built its reputation on steady performance and strong fundamentals, this decline shocked long-term investors. But here's what most people missed. SCHD didn't fall because dividends suddenly became less attractive. It fell because of what's inside the ETF and how the broader market environment changed. SCHD's biggest strength for a decade, its exposure to high-quality, dividend-paying companies, turned into a weakness when interest rates stayed higher for longer and economic growth slowed. Let's break that down. When SCHD launched and gained popularity, its formula was simple and powerful. Pick companies with a consistent track record of paying and growing dividends, filter for quality, and weight them by yield. For years, that strategy worked perfectly. From 2013 to 2022, SCHD crushed the SP 500's volatility, offered higher income, and attracted massive inflows from income-focused investors. But by 2024-2025, the macro backdrop was completely different. The Federal Reserve had pushed rates above 5% and held them there longer than expected. Bond yields became attractive again, meaning investors could earn 5% plus safely. No market risk, no volatility. That created a new problem for dividend ETFs like SCHD. The ETF's yield, sitting around 3.7%, no longer looked compelling compared to Treasury bills. As investors rebalanced toward fixed income, capital flowed out of dividend-heavy ETFs. But the bigger problem wasn't outflows, it was sector exposure. SCHD had become heavily tilted toward financials and industrials, together making up more than 40% of the fund. Both sectors suffered when rates stayed high. Banks faced tighter margins, less loan growth, and rising defaults in commercial real estate. Industrials struggled as borrowing costs increased and global demand softened. Companies like Amgen, Lockheed Martin, Verizon, and 3M, once considered dividend-safe havens, underperformed as earnings growth slowed. Dividend reliability didn't translate into price stability anymore. The ETF's fundamentals were solid, payout ratios were reasonable, debt levels manageable, but market perception shifted. Investors didn't want steady, they wanted growth or safety. SCHD was caught in between. There were also subtle warning signs. In 2023, SCHD's relative strength against the SP 500 started breaking down. The fund lagged growth-focused ETFs like VOO or QQQ, but retail investors ignored it, assuming it was a temporary rotation. By mid-2025, that rotation turned into a structural divergence. What made this fall so meaningful isn't just the price drop. It's the realization that even the most respected dividend ETFs are not immune to macroeconomic cycles. SCHD didn't fail. It simply reflected the type of economy we were in. Still, the pain was real for long-term holders. Many who bought near $75 or $80 are now sitting on paper losses, while reinvested dividends only partly offset the decline. And the lesson here is bigger than one ETF. It's about understanding the composition behind your investments, not just the yield number on the screen. Because in markets like 2025, yield can be a trap, and diversification inside an ETF doesn't always mean protection. One of the biggest reasons SCHD stumbled in 2025 wasn't a collapse in corporate profits. It was structural exposure risk that most investors never noticed. When you looked under the hood, SCHD's top holdings painted a clear picture. Companies like Broadcom, Cisco, PepsiCo, Merck, and Home Depot gave it stability. But beyond that, the ETF leaned heavily into financials and industrials, sectors that are extremely cyclical and deeply affected by interest rates. At the start of 2025, financials made up roughly 22% of SCHD, while industrials contributed another 20% or more. That concentration worked beautifully in the post-COVID recovery when rates were low and credit was cheap. But in a higher-for-longer rate world, those same sectors turned toxic. Banks and insurers struggled with tightening credit conditions, falling loan demand, and mark-to-market losses on their bond portfolios. Smaller regionals were hit even harder after the commercial real estate weakness continued into 2025. Companies like PNC Financial, Truist, and Amgen didn't crash overnight. They just kept bleeding value month after month. That's what made SCHD's decline so deceptive. It wasn't a panic sell-off. It was a slow, grinding erosion of value. Meanwhile, industrials, once considered SCHD's backbone, faced their own set of challenges. Higher input costs, lower export demand, and slower capital expenditure cycles combined to pressure margins. Dividend-paying industrials like 3M or Lockheed Martin struggled to maintain their payout ratios. The market started questioning sustainability, not because these companies were weak, but because the macro backdrop had shifted so drastically. This is where the concept of yield traps kicked in. Investors were chasing SCHD for its 3.74% yield, thinking it was a safe return in a volatile market. But they ignored the underlying reason that yield looked attractive: falling share prices. A rising yield in a falling ETF isn't a gift, it's a warning. SCHD wasn't increasing its payout dramatically. It was the denominator, the price, that was falling. That's the textbook definition of a yield trap. Another major factor behind SCHD's 2025 performance was rate sensitivity. Dividend ETFs by nature are more sensitive to interest rate changes because their cash flows, the dividends, are relatively stable and bond-like. When rates rise or even stay elevated, the present value of those future cash flows declines. Investors can suddenly earn 5% from a treasury bill risk-free, so they ask, why hold a volatile stock ETF for 4%? That shift in opportunity cost pulled billions away from dividend-focused strategies. What made it worse for SCHD is that it lacked exposure to the sectors that were working: technology, communication services, and energy. While mega-cap tech stocks like Nvidia, Microsoft, and Meta surged again in 2025, SCHD's rules-based selection excluded most of them because they didn't meet the long-term dividend growth criteria. The result was an ETF stuck in yesterday's economy, while capital flowed into tomorrow's winners. Still, long-term investors need to remember, SCHD isn't broken. It's just out of sync with the market's current phase. The same fundamentals that hurt it in 2025, discipline, quality screens, and yield weighting, are the same ones that can help it recover when the cycle turns. But the key takeaway for any dividend investor is this: never confuse quality with immunity. Even the best ETFs can underperform when the macro winds blow against them. The fall of SCHD is not about bad management or poor stock picking. It's about how macro cycles, sector biases, and yield perception can distort short-term returns. And if 2025 taught us anything, it's that even safe ETFs can become risky if investors stop asking why the numbers look attractive. One of the biggest reasons SCHD's decline in 2025 hit so hard wasn't just the market itself, it was the reaction of investors. The psychology behind dividend investing completely flipped this year. For years, investors saw SCHD as the safe bet, a place to park money and watch it compound quietly while collecting reliable dividends. But when the share price fell below $65, fear started to take over. People who claimed to be long-term investors began checking their portfolios every day. They forgot that SCHD isn't built for monthly excitement. It's built for decade-long consistency. The irony is, nothing fundamental broke inside the ETF. Its companies were still paying dividends, most were still growing them. But because the price chart looked ugly, investors began treating SCHD like a growth stock that had lost its narrative. This emotional shift revealed one of the hardest truths in dividend investing. Most people love dividends until prices fall. The same 3.7% yield that looked comforting in 2022 now felt meaningless when portfolios were down 15 to 20%. That's when yield chasing became dangerous. Some investors started jumping to higher yield ETFs, ones paying 6%, 8%, even 10%, ignoring the fact that higher yield usually means higher risk. Meanwhile, the long-term disciplined investors held their ground, but they faced a new kind of pressure: relative underperformance. Growth ETFs like QQQ were climbing again thanks to the AI boom, while dividend-focused funds lagged badly. On social media, dividend investing was being mocked as boring or outdated. That narrative added psychological fuel to the sell-off. Many retail investors simply couldn't handle seeing SCHD trail the market for the second consecutive year, and they sold right near the bottom, exactly when smart money started accumulating again. But this is where the lesson deepens. Dividend investing isn't about beating the market in every phase. It's about compounding wealth through stability and reinvestment. SCHD's dividends didn't stop. In fact, its 2025 payout was slightly higher than the previous year. The cash flow kept coming. What hurt investors wasn't the ETF strategy, it was their impatience. The reality is that dividend ETFs behave differently depending on the interest rate cycle. When rates rise, capital appreciation slows, but income remains steady. When rates eventually fall, the same dividend stocks often outperform because they've been undervalued for too long. It's a cyclical game, and those who understand that cycle use downturns like 2025 as accumulation opportunities, not exit signals. Another overlooked concept here is the difference between income investing and total return investing. Many investors confuse the two. Income investing focuses on cash flow, those quarterly dividend checks. Total return investing focuses on both income and capital gains. SCHD was never designed to be a growth monster. It was built to generate sustainable income and moderate growth over time. When investors treat it like a tech ETF, disappointment is inevitable. In 2025, the high-rate environment exposed this misunderstanding brutally. The market was rewarding companies with reinvested profits and aggressive expansion, not mature businesses paying out 50% of their earnings as dividends. SCHD's underperformance wasn't a signal to abandon it. It was a reminder of what it truly represents: discipline, patience, and predictability. And that's exactly what long-term dividend investors need to internalize. The compounding power of SCHD comes not from price spikes, but from consistent reinvestment of dividends when prices are low. The irony is that the same investors who are complaining about the drop are the ones missing the best entry points they've had in years, because when fear dominates and prices drop, yields rise. And that's where long-term wealth quietly begins to build again. So here we are, late 2025. SCHD, once viewed as the rock-solid foundation of dividend portfolios, is trading near $65 per share, down roughly 15–20% from its highs. But this isn't the end of the story. It's a transition point, one that separates emotional investors from disciplined wealth builders. Because the truth is, the same forces that pulled SCHD down could become the seeds of its next rise. Let's talk about what investors should actually do now. The first step is to stop thinking in terms of short-term performance. Dividend ETFs like SCHD aren't meant to win every calendar year. They're designed to win over decades through compounding. If your goal is monthly or quarterly income, price volatility is not your enemy. It's a gift. Lower prices mean reinvested dividends buy more shares, increasing future income without adding extra capital. Many experienced investors understand this simple math. When SCHD drops from $75 to $65, its yield effectively climbs closer to 4%. If the underlying companies keep paying and growing dividends, the long-term return potential actually improves. The pain in 2025 is not a sign of weakness. It's a revaluation caused by macro headwinds, not broken fundamentals. Second, diversification. One of the biggest takeaways from SCHD's decline is that sector concentration matters, even inside ETFs. Financials and industrials won't always lead the market. For a well-rounded dividend portfolio, investors need exposure to different dividend philosophies, not just high yield, but dividend growth and total return. Mixing SCHD with funds like VIG, Vanguard Dividend Appreciation ETF, or even a balanced ETF like VTI, can smooth out performance over time. SCHD was never meant to be a one-stop shop. It's a piece of a bigger puzzle. Third, investors need to learn the difference between price pain and permanent loss. SCHD's holdings, names like PepsiCo, Broadcom, Merck, and Home Depot, are still some of the most durable cash-generating businesses in America. They've survived recessions, inflation, and market rotations before. As long as those companies continue to produce profits and pay dividends, SCHD remains structurally sound. The market is simply repricing it in response to interest rate dynamics, not rewriting its long-term story. Another important mindset shift is to stop chasing hot sectors just because they're outperforming today. The same investors abandoning SCHD for AI or tech growth ETFs in 2025 are repeating the same mistake people made in 2020 when they sold value for momentum. Every cycle reverses. When the Fed eventually cuts rates, or when growth slows again, yield and cash flow will regain their shine. That's when SCHD could quietly outperform, and only those who stayed invested will benefit. Think of SCHD in 2025 not as a failure, but as a reset button. It's rebalancing toward lower prices, higher yields, and more attractive entry points. If anything, this phase will likely lay the foundation for its next wave of returns. Because history shows, dividend strategies underperform in high-rate environments, but they almost always rebound stronger when rates fall. And for long-term investors, that's the real game. You're not betting on 2025 or 2026, you're building a portfolio that works through 2035 and beyond. If you can detach from the noise, reinvest consistently, and focus on growing your income stream rather than your portfolio's daily value, you'll end up ahead. SCHD's story isn't about collapse, it's about perspective. It reminds us that even the most trusted ETFs have cycles. Prices go down, yields go up, emotions run wild. And that's when the best investors quietly accumulate. The fall of SCHD isn't the end of dividend investing. It's a wake-up call for every investor who confused stability with immunity. Because at the end of the day, markets reset, rates fall, cycles turn, and the ones who stayed patient through the noise will be the ones collecting the biggest checks when the next bull run begins.